Alright, what's up my friends? So a little bit of a different video tonight. Usually I like to come and kind of talk about the setups I'm trading, give you a watch list, some trade ideas, and we'll be doing that tomorrow for sure. What I want to talk about tonight though is just kind of the management of emotions, while you're swing trading, and a bit more specifically, what warrants an exit. Like at what point should you jump ship and move on to another setup versus when should you hang on tight? And to me, it's really simple. And keep in mind, like as a newer trader, I struggle with this a lot. And I think it's really important for me to talk about this a lot more this year because I just know a lot of newer traders, they struggle with this as well. But I think a good example is a trade that we currently have in SMH. So as a bit of a preface here, I mean, this thing's beautiful. Right? Picture perfect daily squeeze, weekly, daily stacked EMAs. Your 10x bars are green pretty much everywhere. And I'm getting my buy signals, which this is something we're working on right now over at Simpler that I do hope we can kind of bring to you in the next handful of months here. But hopefully this kind of simplifies the whole process of when do I hang on tight and when do I jump ship. But regardless, I'm getting buy signals like every day here for the last month and a half. So anyways, it's a great looking setup, and we're taking our entry yesterday. Now, today, at one point during the session, the semiconductors are down like 2.5%. Right? So there's this big, ugly red candle. If you look up here, there's that big, scary number, right? Minus 2.5%. In this instance, like that doesn't really mean shit. The fact you're down 2.5% today is completely meaningless in regards to the quality of the trend, structure, and the momentum here. In other words, if in your opinion the semiconductors have been a bullish setup for the last handful of days, or the last month and a half here, well then guess what? Nothing about this morning's 2.5% dip changed any of that. So that's the most important thing I ask myself whenever I'm in this kind of situation. I've got a long position. Whenever I'm long is down 2-3%, the first thing I ask myself is, has anything changed? And what I mean by that is every trade I'm taking it for a couple specific reasons. Right? It's all about the trend structure and that momentum profile. So again, yesterday, why am I getting long the semiconductors? I'm buying SMH, or I'm selling a put credit spread rather. You know me. But I'm getting long the semis yesterday because we're in a bullish daily squeeze with a positive histogram, daily and weekly stacked EMAs, daily and weekly green 10x bars. So that's why I'm getting long yesterday. And today, none of that changes. None of it. It's still a bullish daily squeeze. It's still trading above the 21. My histogram down here, she's still positive. I still got my weekly, daily green 10x bars and stacked EMAs. It's the same exact setup it was yesterday. But way too often for newer swing traders, that big red candle, right, it feels ugly, it looks scary. You're seeing all these ugly numbers. It's so easy to get in your head and get shaken out of great looking positions. And one thing that I love to talk about, pretty much any time I get the chance to talk, whether it's the training room or the options room or my mastery, is when you're trading daily squeezes. And rather, when you're trading any squeeze in any time frame, in my opinion, you have to be like fully comfortable sitting through +1 to -1 ATR. My favorite example of this, right? And mind you, I came up as an options trader basically on the teachings of John, right? JC from Simpler. One of the things I learned from his book. There's a few chapters down there talking about the squeeze and talking about reversion to the mean, but one of the most important concepts is your squeeze is going to travel between +1 and -1 ATR until it's ready to fire either which way. So one of the bigger trades for a lot of us over here at Simpler earlier last year was the daily squeeze in Google. Right? Now, if you're going to abide by the rules of, hey, a daily squeeze is a daily squeeze, so long as we're trading between +1 and -1, you don't have any issues here. Right? But if that little pump gives you some euphoria, right, and then the next day you feel the anxiety, and then there's euphoria, there's anxiety, there's euphoria, there's fear. If you're getting all kinds of involved emotionally on all that back and forth, you're going to really reduce the odds of you sticking around to catch the move that follows. In other words, nothing changed here. We liked Google because Google was in a solid daily squeeze. All that back and forth doesn't change that. But if you're living and breathing every tick, right, and you're watching every little, move on the 5-minute chart, you run the risk of getting shaken out, and you run the risk of making a decision based on emotions rather than a decision based on structure. So one of my favorite examples this year, because of the patience that took. Daily squeezing, finally gets the move. But if you let that kind of stuff shake you out, right, the crap that doesn't change any kind of structure, it's so much harder to catch the rewards. So with the semiconductors today, we're in the mastery together. It's down 2.5%, and it's like, listen, guys, I get it. It is, certainly my preference that this thing rips 2.5% to the upside today, but not a damn thing changed about the big three: trend, structure, momentum. You don't get shaken out of that. An example of the opposite here is DDOG. Now, granted, we didn't trade DDOG, but it was on the watch list. And if you look at DDOG last week, you had a great setup here. I'm getting early buy signals. You had stacked EMAs. You had a positive histogram. We could have very easily found ourselves taking a position here in DDOG. And it would have been a good trade, right? It would have been a good entry. However, something changed here. Right? So for me, I would have gotten long DDOG because you're in a bullish daily squeeze of the positive histogram with positively stacked EMAs. Well, that all kind of got thrown out the window here. Histogram loses momentum. You're losing your stacked EMAs. You're under your 8. You're under your 21. You're under your 50. You're even breaking through recent support, and you're breaking under the weekly 21 EMA. So maybe this bounces back tomorrow, but today something changed, right? Very clearly, this is not a bullish daily squeeze. Really just try to keep it that simple, right? If you got long DDOG back here because it's a bullish daily squeeze, well, at this point, it ain't a bullish daily squeeze. That kind of price action, that kind of shift of structure and momentum, that's what warrants an exit. That's a little bit more than noise. But man, if you're long the semis here, you can't get shaken out today. It's still a bullish daily squeeze. It still has the momentum. It still has the trend. It still has everything you've been looking for as far as a good bullish opportunity. So hopefully some of you find this helpful. We're long AMD right now. AMD is down 4% today. But why are we long AMD to begin with? It's a daily squeeze, trading near the buy zone, with positively stacked EMAs and green 10x bars on the weekly and the daily. That didn't change over here, and guess what? Even with today's 3.5–4% move to the downside, AMD is in a bullish daily squeeze with stacked EMAs and green 10x bars on the daily and the weekly. In other words, nothing changed. Can't get shaken out of that. Now, AMD might roll over tomorrow. It might roll over next week. But you have to live in the present moment as a trader when you're making these risk management decisions. In the present moment, it's the same exact setup it was 2 weeks ago when I originally jumped into the trade. So a shorter video tonight, but getting the opportunity to work with a lot of traders in the options room, the opportunity to work with a couple hundred traders in my mastery, I can just remember, what it was like for me kind of coming up as a trader, and I can still see it in newer traders. There needs to be much more of a structure over everything mindset. None of that should shake you out. Just my opinion, of course. But hopefully a few of you find this helpful, right? So that's my biggest suggestion as far as how do I manage risk? How do I know when it's time for me to exit a trade versus when do I hang on tight and not get punked out? Well, have very, very clear reasons for why you originally took the trade. And as long as those reasons and all that criteria are still present and still lined up, it's the same trade. Whatever selling pressure, whatever ugliness might be taking place, isn't changing anything. That's when you hang on tight. And if anything, it's when you buy a little bit more. But when you get something like a DDOG, where 5 days ago it was a bullish daily squeeze, and today it's no longer a bullish daily squeeze. You can that sucker, and you move on to the next one. So I hope some of you find this helpful. Quick update on our end here. Yesterday we took profits on our forward swing trade. So one of the ideas we've been bringing for the last couple of weeks here, I thought my exit yesterday was pretty good. Left a little bit on the table, needless to say, but a pretty good trade. So short and sweet, we're on to the next one. We also took profits on Apple yesterday in the options room. And we're taking our entry back here in that 4-hour squeeze. It pretty much takes you up right into that 183-ish level. So Apple's a $3 trillion company up there. We took profits on that push. And that 4-hour squeeze pretty much gave us what we were looking for. So we're taking profits there on Apple, taking profits yesterday on Ford. And then in my mastery, we bought back a QQQ put credit spread for 80% of max profit yesterday, and we took it back here. Nothing changed, so we held on to it. So we bought back one spread yesterday for about 80% of max profit, and because today's dip didn't change anything, we actually got a little bit more. We got a January 28th expiration 400 strike put credit spread. So we picked up some QQQ today, took some profits there yesterday, and we've also got a little bit of AMD. We still got some Amazon here. Now, if you look at Amazon, nothing changes yesterday. So if you're long yesterday, you really shouldn't get excited. You can't get back above the 21, so nothing has changed. And if you're long Amazon and it's down 2% today, well, there shouldn't be any emotion. Nothing has changed. You're trading in the same range. So we've got some Amazon, we've got some QQQ. We've also got a little bit of Dollar Tree here in my mastery. And as always, I'm looking for the next solid trade. But I like the semis, I like tech. Got a few other spots here of interest like the home builders. And these are all spots that we can take a bit of a deeper look at tomorrow morning during the pre-market prep at 8:45 a.m. Eastern here on the channel. And I'm sure I'll cover a lot of this in tomorrow night's video as well. But I hope some of you find it helpful. If you do, let me know in the comments below. But that's kind of my golden rule. Has anything changed? If all the reasons that I took the trade are still present, then I got to tighten my belt, kind of man up, so to say, and hang on tight. And let that daily squeeze. As long as you have structure and momentum in your favor, there's a pretty good probability that squeeze fires in the direction of the overall trend, and that's how I'm positioned right now. But I will talk to you all tomorrow morning. See you for pre-market prep.